Good evening, students. Welcome to the session. I hope you have revised your capital gain. Okay, so what we are going to do now is we have almost covered most of the important provisions of the capital gain. What I'm supposed to cover now is today actually it's going to be the income from other sources last. So what we are going to do is we are going to first cover the balance capital gain, and then we are going to move towards the income from other sources. Okay. So what is remaining in the capital gain is the computation aspect. That's what I'm going to cover with you now. So that we'll quickly cover. And then income from other sources is a very small topic. So that we will cover. And if at all it's something balance remains, that we can cover in the next class as well. Okay. So let's get quickly started with it. Okay. So what we had covered in the last class was the reorganization aspect, transfer of capital asset by the holding company to a subsidiary or vice versa situation, amalgamation, demerger, slump sale, all of that we have covered, right? So the computation mechanism for what is the cost of acquisition in those situations, that also we have covered, right? Now we are going to move towards section 50C, which is the stamp duty value for the immovable property, right? Section 50C for the immovable property. Now, in case of the immovable property, where an immovable property has been sold, then in that case, there are two things to it. Immovable property as in the land or building or both. If it is sold, then in that particular case, if the stamp duty value, if the stamp duty value exceeds 110% of the sale consideration, then in that particular case, the stamp duty value is to be taken as the FVC. Your FVC will be your stamp duty value, right? In case the stamp duty value is less than 110% of the sale consideration, then your FVC will be your sale consideration, right? So FVC in that case would be a sale consideration. Now, in case the stamp duty value exceeds 110% of the consideration received, then stamp duty value, whether we have to take on the date of the registration of the agreement or on the date of the transfer. So on which particular date we will consider the stamp duty valuation. So if the date of agreement is different from the date of transfer, then stamp duty value has to be taken on which date? So if the date of agreement is different from the date of transfer, and in the case if the consideration entirely or partly is received on or before the date of the agreement, is received on or before the date of the agreement. So in this particular case, there could be two situations. Whether or let me write it this way. Whether the consideration in whole or in part is received on or before the date of the agreement. Now, this consideration, if it is received on or before the date of the agreement, the condition is that it should have been through the account pay check or by way of the digital modes, right? So, through ECS or through any digital mode, right? So, the question you have to ask is if the consideration is received by way of check or account paid check or through the bank draft or ECS or any electronic transfer, whether it is received on or before the date of the agreement. If the answer to that is yes, if the answer to that is yes, whether the consideration in whole or part is received by way of, sorry, give me a moment. Yes. By way of, there's some issue, 1 second. Yeah. By way of account paid check or electronic mode. This is the question you will ask, right? So where the date of the agreement, fixing the amount of the consideration and the date of registration of the transfer are not the same, then in that particular case, you have to ask the question that whether the amount of consideration fully or partly is received by way of an account pay check or account pay bank draft or ECS or any other electronic mode on or before the date of the agreement. If the answer to that is yes, then in that case, you have to take the date of the agreement. Yes, stamp duty value on date of agreement. In case the answer is no, then you need to take it on stamp duty valuation on the date of registration of agreement. Right? Are we clear? So, in case I have received the amount as on the date of the agreement, then on or before the date of the agreement, then in that particular case, I will take the date of the agreement. But if it is received afterwards or if it is not received through account paid check or bank draft or ECS, then in that particular case, it will be on the date of the registration. Are we clear? Right? So let me just give you an example, or you can write it over here, date of the registration. So just one example you can take down. So let's say the actual sale consideration is equal to, let's say 100 lakhs. Okay. Stamp duty value on the date of agreement is equal to 109 lakh. and stamp duty value on the date of registration is 112 lakh. So in this case, what would you do it? In this case, let's assume if the 10 lakhs are received by way of account pay check on or before the due date of agreement. So rupees, let's say 10 lakh received by account pay check before agreement. So what will be your answer, whether 50C is applicable over here or not? What will be your answer? (50C) applicable? Yes, it will not be applicable. Correct. Vinay Kumar, in this case, 50C will not be applicable. You will take the stamp duty value on the date of the agreement, which is 109 lakh. You will compare it with this. Since this is less than 110% of the sale consideration, therefore 50C not applicable. Are we clear? Clear? Any doubt? Okay. So now let's say where the assessing officer refers the valuation to the valuation officer. So where the assessing officer refers the valuation to the valuation officer because the assessee has disputed the valuation. The assessee claims that the stamp duty value is more than the fair market value of the property on the date of the transfer. So therefore, the assessing officer will make a reference to the valuation officer. So let's say if a reference to the valuation officer where assessee disputes stamp duty value is greater than the fair market value and the reference is made to the valuation officer. Now, if the valuation is greater than the stamp duty value, if valuation is greater than the stamp duty value, in that case, you will adopt the stamp duty value. In case the valuation officer gives the valuation which is lesser than the stamp duty value, then the valuation will prevail. Then the valuation by the valuation officer will prevail. Are we clear? Clear? Okay. Now there is a similar provision under the PGBP also, which is under 43CA. So this is under the capital gain. There is a similar provision which we have not dealt under PGBP because I wanted to deal it here because both of them are similar, which is section 43CA, which is again for the land or building. This is under your business or profession where land or building is held as stock in trade. Held as stock in trade. So there also you have exactly the similar provision there under section 43CA. So what does it provide is that if the stamp duty value of the land and building which is held as stock in trade exceeds 110% of the sale consideration, 110% of the sale consideration, in that particular case, you will have to consider the stamp duty value. And in case it is less than 110%, then you have to consider the actual consideration. So same principle here. Stamp duty value exceeds 110% of sale consideration, then stamp duty valuation. And if it is stamp duty value less than 110% of sale consideration, then the actual consideration you need to take. There is the exception which is provided over there. So there is a small exception which is provided over there, which may not be relevant too much now because that was for the residential unit transferred between November 2020 to 30th June 2021. For that residential unit, it was 120% of the actual consideration instead of 110. But though that is for the units which are transferred in between the November 2020 and 2021, which are transferred, right? So that may not be relevant very much now, right? But that is just some point which I'm telling you, that if it is containing the question that if it is transferred residential unit between November 2020 to 30th June 21, and if the consideration is less than 2 CR, then in that case you need to consider 120% and not 110%. Again, here it's the same thing, that where the date of the agreement and date of registration are not the same, and if whole or part of the consideration is received before the date of agreement through a banking mode, then you have to consider the date of agreement, else you have to consider the date of the registration. Are we clear? It's everything is same over here other than that. Clear? Now, there is one more principle over here. I'll just write it down for reference. If the date of agreement and date of registration is not same, whether whole or part of consideration received through banking mode. If yes, then agreement date. If the answer is no, then registration. Clear? Okay. Now, one more section on the valuation is section 50CA. Now, what is this? Section 50CA is for the consideration which is on the shares other than the quoted shares. Shares other than the quoted shares. So if the consideration received is less than fair market value of such shares, then in that particular case, it will be the fair market value which will be considered. So if the sale consideration is lesser than the fair market value, your full value of consideration will be your fair market value. Now, how do we determine the fair market value in these cases? How will we determine? So this is as per the valuation rules. The fair market value is determined as per the valuation rules. Now, the valuation rules are provided under Rule 11UA. The valuation rules are provided under 11UA and 11UAD, right? So what does it provide? So 11UAD provides that the provisions of 50CA, okay, 11UA first we'll talk about. So 11UA provides the valuation principles for this particular valuation of the fair market value, right? So you can write it down here. valuation as per rule 11 UAA. Sorry, yes. Okay. So what is the valuation for unquoted equity shares? So what you did for the slump sale, it is more or less in relation to that only. So it is A plus B plus C plus C plus D minus L into P divided by PV. Right? So A is the book value of all the assets minus the income tax paid plus income tax refund minus unamortized expenditure. B is the open market value or the market value as per the valuation report of jewelry and artistic work. C is the fair market value of shares and securities. So fair market value of shares and security, again, it is as per 11 UA. Then D is the value of the immovable property. And L is the book value of the liabilities, excluding the paid up share capital of equity shares, reserves and surplus, provision for tax, unascertained liability provision, contingent liability. Remember, all of this is same what we have done it for the slump sale. So if you see A plus B plus C plus G minus L, it's the same. So I'm just putting it out this only. Give me a minute. So it's the same thing. Okay, I'm not able to paste it over here, but I can just write it same as slump sale. This is same as slump sale. Now, what is PE and PEB? PE is total paid up equity share capital. And your PV is paid up value of share capital. Are we clear? So here also what we have seen for the slump sale, it's the same valuation principle. But what you have to just additionally do over here is that you have to consider as per rule 11 UA into P divided by PV, which means that you have to consider the paid up share value over here. Are we clear? Other than that, it is very much similar to your slump sale provision itself. Clear? Any doubt? Now, with respect to the value of the shares and securities, so in that particular case, we will again see this provision when we will be doing 56 to 10. There also we'll come up with the valuation principle again, and there you will see that the same thing we are going to see over there as well, right? Okay, sorry, here you should have into PV divided by PE. So same you will again see it when we will be talking about the valuation under 56 to 10 as well. Are we clear? Any doubt? Okay. Now this was about 50CA. Okay. Now there is one exception which has been provided under Rule 11 UAD. What is that exception which is provided over here? The exception is that Rule 50CA will not be applicable to a company which has gone into the insolvency resolution. So you can write it down. Exception. The exception which is provided is that the rule will not be applicable. Rule will not be applicable. Sorry, 50CA, or you can write not rule. Section 50CA not applicable to the company which has gone into or which has been transferred into resolution which has been transferred to the IBC or resolution, you can write it down. Insolvency resolution, that is A. And secondly, B is where the tribunal has suspended the board of directors. Board of directors. Are we clear? So this is for the 50CA. Clear? Okay. Next is section 51. Advance money forfeited. Now, advance money forfeited, advance money received which has been forfeited. Earlier, it used to be reduced from the cost of acquisition, but now earlier what used to happen is that 51 section used to provide that while calculating the capital gain, the advance retained by the assessee must be reduced from the cost of acquisition. But now it is specifically chargeable as income under 56(2)(9). Okay. So under 56(2)(9), you can write it down. Income from other sources. This is considered as the income from other sources. Clear? And it shall not be included in the, it shall not be reduced from the cost of the acquisition. Are we clear? Okay. Now, moving towards the tax rates. Now, moving towards the tax rates. Now, what are the tax rates of the specific, which are there specifically under the capital gain? See, tax rates, as I had told you last time also, we get the tax rates through the Finance Act, which are the slab rates normally, right? But there are the tax rates which are provided specifically for the capital gain. So there are specific rates which are also there, which is under 111A, 112 and 112A, right? Then in that particular case, we will have the specific rates which are applicable. So what are the tax rates for the capital gain? We have 3 tax rates. (112A), 112 and 111A and 111A. Are we clear? Now, first I'll talk about the 111A, or let me divide it in this way. Wait a second. Let me redo this. Okay. Long-term and short term. Okay. For long term, we have section 112A and section 112. For short term, we have 111A and then normal rates. Right? So first, I'm dealing with the short-term capital gain. Short-term capital gain, if it is a listed equity share, right? What are the assets here? Listed equity share. Second, unit of equity-oriented fund. Third, unit of business trust. Then, in this particular case, the capital gain tax will be 15%. The capital gain tax will be 15%, right? Under 111A, your capital gain tax is 15%. Clear? It will be 15%. So, what are the three assets over here? It is on which the STT should have been paid, equity oriented fund, units of business trust. So the STT should have been paid on all of this, right? You can write it over here, on which STT is paid. You can write one more year on which STT may not be paid, but still it is included under 15%, which is on the transactions undertaken on the recognized stock exchange in IFSC. Transactions undertaken on recognized stock exchange at IFSC in Forex, even that is covered under 111A. Under 111A, in case of the resident individual or HUF, you can utilize the unexhausted basic exemption limit. So you can write it down over here. In case of resident, this is not available for a non-resident, only in case of resident, individual or HUF, you can utilize exhausted by any other income, then you will reduce the amount for the unexhausted basic exemption limit to the extent of the short-term capital gain, and on the balance you will apply the 15%. So let's say, for example, if my interest income is 1 lakh, so still I have 1.5 lakh basic exemption limit left, and let's say if I have the short-term capital gain of 3 lakh, then I will apply 1.5 lakh on that 3 lakh. So balance 1.5 lakh will be taxable at 15%. Are we clear? Further, no chapter 6A deduction is available. No chapter 6A deduction. Are we clear? So this is for 111A. Other than this, assets, everything else will be taxable at normal rates. Clear? Now, in respect of the long term, capital asset, now first we will be covering 112A. First we are covering 112A, which is for the under 112A is for the listed equity shares, right? And the equity oriented mutual funds. So I'll be writing 112A separately only because here otherwise there will be a space constraint. Okay. 112A. Okay. Let's try and understand about 112A. Now 112A, as I said, is for the listed equity shares. It's for the listed equity shares. So an equity oriented mutual funds, like the way we have it under 111A. So you can write it down. What are the assets which are covered over here? Listed equity shares, right? On which STT is paid at the time of purchase plus sale. At the time of purchase plus sale. Second is listed equity oriented fund, equity oriented mutual fund, where the STT is paid at the time of transfer. Third is units of business trust, where the STT paid at the time of transfer. Right? And last one, transaction on a recognized stock exchange at IFSC in foreign exchange. Here there is no requirement of STT. So even if no STT paid. Are we clear? So all of this will be taxable at 10%. Right? At 10%. Here, no Chapter 6A deduction available. No rebate available under section 87A. Clear? You can utilize, again, sorry, write it down over here. Resident, individual, or HUF, only resident and not a non-resident. Be careful of this thing in your exam. Resident, individual, or HUF can utilize unexhausted basic exemption limit. Okay. Also, one more thing over here. Be very careful. Here, this is taxable. This particular long-term capital gain is taxable only if it exceeds greater than, only if it is exceeding rupees 1 lakh, the balance amount will be taxable at 10%. The balance amount will be taxable at 10%. Are we clear? So long-term capital gain exceeding rupees 1 lakh will be taxable at 10%. Now let's say, for example, if my other income is rupees other income is say rupees 1 lakh. My long-term capital gain is, let's say, rupees 3 lakh. So in that particular case, you have to tell me how much my long-term capital gain will be taxable. I am a resident individual. How much my long-term capital gain will be taxable? How much will be my long-term capital gain which will be taxable? Yes, quickly tell me. Okay. See, understand how much my long-term capital gain will be taxable is here. First, I will utilize my basic exemption limit towards 1 lakh. I still have 1.5 lakh. 1.5 lakh, I'll reduce from long-term capital gain, which is 3 lakh. Balance 1.5 lakh, out of which 1 lakh will not be taxable. So only on rupees 50,000, you will pay 10%. Understood, Jacob? It's not on 1 lakh, it is on 50,000 because I have utilized my unexhausted basic exemption limit. Jacob, the difference between PV and PE is that the PV which is there is total paid up share capital and PE is the paid up share capital in relation to only those shares. Clear? Are we clear? Okay. So now moving forward, here there are certain transactions which are covered over here even if the STT might not have been paid on those transactions. So see 112A which is there, the condition is that the STD should have been paid at the time of purchase as well as at the time of the transfer in case of the equity share. However, it is possible that sometimes in genuine transactions, the STT might not have been paid for the reason that these are the off-market transactions. What are such transactions? So the central government has issued the notification number 60/2018. So you can write down over here. Other than those exempted wide notification number 60/2018. Are we clear? So this will not apply in relation to the transaction where the acquisition of the listed share in a company has been approved by the court. So where the acquisition has been approved by the company law tribunal or by the Supreme Court or by High Court or by SEBI or RBI, any such kind of acquisition which is approved by the court or RBI, in that case, the security transaction tax would not have been applicable, and therefore that is a genuine transaction, and that will also be covered under 112A. So one cannot say since the STT has not been paid on that transaction and therefore it will not be covered by 112A. That will not be the case because there is a specifically exempted. Where the acquisition is by a non-resident in accordance with the FDI, in accordance with the Foreign Direct Investment Guidelines. Right? So in these cases, it will not be considered that these transactions are not genuine. So these are the preferential issues which are made, right? These are the preferential issue and therefore there will not be any problem. Then in case where the acquisition is by the banks, where the acquisition is under the ESOP scheme, because under ESOP again I'm not purchasing through the market, so STT would not have been paid at the time of purchase. Where acquisition is from the government, where acquisition is maybe in the form of the transfer of capital asset under a gift, where the acquisition has been due to the transfer between a holding company and a subsidiary company, which we saw, which was exempt under 47(4) and 5, or by a subsidiary company from the holding company, where the shares have been transferred as a part of amalgamation or demerger or slump sale, where the shares have been transferred as the capital contribution by the partner in the firm or by the firm to the partners on dissolution under 45(3) and 45(4), where the acquisition of shares is through a rights issue or bonus issue. Then in all these cases, since these are genuine transactions, the STT would not have been paid at the time of purchase, and therefore even then these are the exempt transactions. These would be the exempt transaction. Are we clear? Any doubt? Now, what is the computation under 112A? So here, understand the computation will be for the listed equity share. FBC will be my sale consideration. FBC will be my sale consideration minus cost of acquisition. Minus cost of acquisition. Now, how do we calculate the cost of acquisition? So, if my specified asset means these is equity shares or equity oriented fund or business trust is acquired before 1st April 2018. Is acquired before February 2018, not April, 1st February 2018. Then in that case, it is higher of A or B. Higher of A or B. What is my A? A is my cost of acquisition. Then B is my lower of one and 2. Now, what is 1? 1 is fair market value as on Jan 31st, 2018. As on Jan 31st, 2018. 2 is the sale consideration. Are we clear? So higher of cost of acquisition or lower of FMV and sale consideration. Out of these two, I have to get the higher value. Clear? Further, in case if the specified asset is acquired after 1st February 2018, is acquired after 1st February 2018, then it is purely cost of acquisition. Here, no indexation benefit is available in this particular case. No indexation benefit and forex fluctuation benefit. So first and second proviso to section 48 not applicable. Clear? Are we clear? Now, here we have mentioned that lower of FMV and sale consideration. What is the fair market value over here? So let's try and understand. Fair market value is different. What is my fair market value? So in case of listed shares, right? In case of the listed shares, what is my fair market value? So fair market value in this case is the highest price. In case the shares were listed on 31st January, then it is the highest price on 31st January 2018. Highest price January 2018. In case my shares are listed as on the 31st January 2018. Clear? So this is what we are computing is the fair market value. This is what I'm talking about is the fair market value if the shares are listed as on the 31st January 2018. Now, in case I have the shares which are listed, not listed on 31st January. In case not listed on 31st January 2018. Other than the equity share capital. Meaning this is about the equity oriented mutual funds or the units of business trust. Then in that particular case, NAV of the unit. NAV of the unit. In case it is equity share not listed on 31st January, then in that case, FMV will be the cost of acquisition into CII of the previous year 1718 divided by CII of year in which previous year in which asset was first held by assessee. CII of the year in which asset was first held by assessee. Clear? So this is your cost of acquisition. Shall we solve one example on this? No, 112A is mandatory, Vinay. It's not optional scheme. It's not at all optional. Okay? Shall we solve a question on this? On 112A? Okay, let's solve it. So let's say my cost of acquisition, this is scenario 1 and this is scenario 2. As on 20th September 2017. In scenario 1, it is 900. In scenario 2, it is 300. FMV as on 31st January 2018. It is 300 and 100. Then selling price is 910 and 400. What is my cost of acquisition and what is my capital gain? In first case, what is my cost of acquisition? Yes, quickly tell me. Cost of acquisition here will be what? 900. Yes, you're correct. Correct, Vinay, it's 900. Yes, this is listed, Jacob. We are talking about the listed shares only. Yes, capital gain is 10. Correct, Vinay. So here, if you see, what is my cost of acquisition? It is, first you have to see lower of this amount, which is 300. Higher of this is 900. So cost of acquisition will be 900 and capital gain will be 900 minus 910, which is 10. What about in the second situation? What is cost of acquisition and capital gain? Second, Vinay, yes, 300, that is correct. So if you see lower of this, 100. Higher of this, 300. So 300 is my cost of acquisition. Capital gain is 100. Are we clear? Are we clear? Any doubt? Okay. So this is how you need to consider here. This is how it needs to be considered over here. Any other question? Any doubt? Okay. Okay. Now, one more thing over here is, let's try and understand one more thing. Okay, or let me give you one example over here. See, let's say the third scenario, cost of acquisition is 410. FMV is 730. Selling price is 760. Selling price is 760. So then in that case, what will be your cost of acquisition? What is the cost of acquisition? Yes, that's correct. Correct, Bhomik. Correct, Vinay. Yes, Jacob. Correct. So here, first of all, lower of this 730, higher of this 730. So 730 is my cost of acquisition, and this will be 30 capital gain. Clear? Okay. Now the last section under the taxability is 112. Last section under the taxability is 112. But before that, just one more point I would like to highlight over here for your reference. See, there is the surcharge applicable on the individuals. If you remember, the surcharge is 25% where the income exceeds 2 crores and 37% where the income exceeds 5 CR. However, you have to remember that the enhanced surcharge is not applicable on STCG under 111A and 112A long-term capital gains. Enhanced surcharge, I am not saying that the surcharge is not applicable. I am saying that the maximum surcharge which can be levied on 111A gains and 112A gains is 15%, even if my income exceeds 2 CR or 5 CR. So you can just write it down a point over here. Maximum surcharge on long-term capital gain under 112A or short-term capital gain under section 111A is 15% even if capital gain exceeds rupees 2 crores or 5 crores. Are we clear? Clear? Okay, last one more point over here. In case there is right issue or the bonus shares which are issued before 1st February 2018, then what will be the cost of acquisition in that case? The cost of acquisition will be the fair market value as on 1st February 2018. So you can write it over here. You can write here cost of acquisition for bonus or rights share. This is I'm talking about before 1st February 2018. Acquired before 1st February 2018. That is the FMV as on 1st February 2018. 1st February 2018, you will take the FMV. Okay? Or sorry, you can write it down. FMV as on 31st Jan 2018. Okay? Now we are moving towards 112. We have covered 112A. Now we are moving towards 112, which is the last section for your tax on capital gain. Now this 112A, if you see, this is for the other than listed equity shares. But again, here also we have different tax rates which are applicable. Let's try and understand that. So under 112A, under 112, if it is a case of resident individual or HUF, if it is a case of resident individual or HUF, then in that particular case, 20% of the capital gain. It is 20%. In case it is resident AOP or BOI, in case it is resident AOP or BOI, then also it is 20%. Resident firm or LLP is also 20%. But for resident individual and HUF, you have the option of exhausting the unutilized basic exemption limit. So, unexhausted basic exemption limit is allowed. This is, as I said, only for the resident individual or HUF. Clear? For domestic company, it is again domestic company. For the domestic company, it is 20%. Domestic company is also 20%. For the non-resident, for the non-resident, it is 20% again. But there are two categories for the non-resident. Okay, that we are going to see. Time being, it's just you can consider 20%. Okay. Now, understand one thing. This, what I'm telling you, in case of the listed securities and zero coupon bonds, listed securities and the zero coupon bonds on which the STT would not have been paid. So you would say, ma'am, listed securities are covered under 112A. So what you're saying under 112, so in case where there is listed securities which are not covered under 112A or zero coupon bond, or in case of a zero coupon bond, then it is 10% without indexation. 10% without indexation. So, here you can write it down. Here you can write it down. Listed securities other than covered under 112A and zero coupon bond is 10% without indexation. Is 10% without indexation. Are we clear? So in other assets, it is 20%. In case of other assets, it is 20%. Secondly, as I said, for non-resident, there are two rates. For non-resident, there are two rates basically available. What are that? So, in case of Only for non-resident, okay? Unlisted, only for non-resident, unlisted securities or share of private company. Unlisted security or share of private company, it is 10%. It is 10%. Clear? Without indexation or foreign exchange fluctuation. Without, one second. Without indexation or forex fluctuation. Clear? Are we clear? Are we clear? Any doubt? Any doubt? Any questions? Any doubt? 1128 is 10%, Vinay. Yes, Vinay. HUF also rested. Okay. Any questions? Any doubt? Okay, fine. Now, last one thing, what we would want to cover is capital gain vis-a-vis the business income. Okay. So, when can we say that the income is taxable under the head capital gain or under the business income? So, there has been circular with respect to that. You can write it down. Capital gain versus business income. This is under CBDT circular number 06 of 2016. So it is quite possible that the shares or securities are traded and held as stock in trade also. So over the years, CBDT has given guidelines. There have been court's decision on that, whether it will be considered as business income or capital gain. And CBDT has given several instructions from 1989, in 2007 again, and again in 2016, right? So it depends on the nature of the transaction. It depends on the how it is treated in the books of accounts. It also depends on the frequency of the transaction. So all these circumstances will determine as to whether the income is a capital gain income or a business income. So there are various factors which needs to look into account, right? It's not that it's only one thing. So it could be that what is the frequency, what is the period of holding, what is the intention of the transaction. All of that needs to be looked into. But primarily in 2016, the CBDT clarified that there were so many disputes on that. So the CBDT clarified that where the assessee opts to treat the shares and securities as stock in trade, where the assessee himself has treated the shares and security, listed shares and security as stock in trade, it will be treated as business income. Where the assessee himself is treating it as business income, it will be accepted. Where the listed shares and securities are held for a period of more than 12 months, and the assessee desires to treat as capital gain, the AO will consider that as capital gain. So the stand once taken by the assessee will not change in subsequent years. The taxpayer will not be allowed to opt in for different rules, different stand in each and every year. The taxpayer has to be very specific as to how does he want to treat. Clear? However, if it appears that the transactions are bogus or any sham transactions are undertaken, then in that case, the assessing officer can disregard the assessee's classification and can recharacterize it either as business income or as capital gain as the facts and circumstances of the case will demonstrate. Are we clear? Any questions till now? Any questions? Any doubt? Any doubt? Any question? Is this clear? Is the entire chapter clear to you? Yes, Jacob, for 20% indexation benefit is available. We are going to just talk about the indexation benefit also now. Okay. Okay. So last now one thing, two things are remaining. One is the 54 exemptions, the exemption of the capital gain, what we are going to talk about it now. And we are going to talk about section 48, which is your which is your computation of the capital gain, which is your computation of capital gain. Okay. So now in the computation of capital gain, section 48 will help you determining the computation, isn't it? And then we have to also talk about section 50, but we have already spoken about that, but just very quickly we'll go through it. Okay. So now section 48, as I was telling you, section 48 is giving you the computation mechanism for the capital gain. Now, how do you compute the capital gains? The cost, you will have the fair value of consideration, which will be your cost of acquisition, right? Then you will get, sorry, fair value of consideration will be a sale consideration. Then you will also have the cost of acquisition allowed to you. And then you have the indexed cost of acquisition, right? Then you have the indexed cost of acquisition. So index cost, what is the indexation for this particular year? What is the indexation which is there for this, for your particular year? So for your particular year, you will have to take CII. CII for your year, what is it? What is the CII for your particular year? Any idea? Quickly, you must be knowing that, right? So CII is for the year 2022-23 is 331. For financial year 22-23 is 331. So you will take that into consideration while computing the capital gain. Just remember this particular point. Okay. Okay. Now the income chargeable under the head capital gain, you will also reduce the expenditure incurred wholly and exclusively in connection with the transfer. So this is how you make your computation. Fair value of full value of consideration is your sale consideration less expenses on transfer, right? This will give you net sale consideration less indexed cost of acquisition less indexed cost of improvement or cost of improvement. This will give you long-term or short-term capital gain. Clear? Now, if you remember, under section 48, we have already touched upon some part of 48, which was 48.3 for the purpose of computing the capital gain in case of the reconstitution of the partnership firm. So that we have already touched. Other than that, there are different provisos to section 48, which I'm going to deal it now. Okay. So 48 section. So the first proviso to section 48. First proviso to section 48 is exchange rate fluctuation benefit. Is exchange rate fluctuation benefit. So while computing the capital gain, the foreign exchange fluctuation benefit is given to a non-resident. This is applicable only for a non-resident, where the capital gain is arising from the transfer of, this is applicable in case of shares or debentures of Indian company. Shares or debentures of the Indian company. So this exchange rate fluctuation benefit is given by converting the cost of acquisition, the expenditure expenditure incurred, your full value of consideration into the foreign currency, and then calculating the capital gain. And the capital gain which is computed in the foreign currency will be again reconverted into Indian currency, so that you get the benefit of the foreign exchange fluctuation. So where the shares are purchased in foreign exchange by a non-resident, shares or debentures of the Indian company, then in that case, the foreign exchange fluctuation benefit will be given. Are we clear? Foreign exchange fluctuation benefit is given in that particular case. Clear? Now, how do you compute that? You can just write it down. We are going to deal this elaborately when we will be going into the international tax class. But just for your sake, I'm just putting it down. We will deal with the example also at that point in time. But right now, you can just write it down over here. This will be as per rule 115A. And how do you do that? Sale consideration, convert at average of TTBR and TTSR. What is TTBR? Telegraphic transfer buying rate and telegraphic transfer selling rate as on the date of transfer. This has to be converted. Okay. Same is for the expense on transfer. Average of TTBR and TTSR as on the date of transfer. Cost of acquisition. Average of TTBR and TTSR as on the date of acquisition. Finally, the capital gain will be computed, which is computed in this particular way. And then you have to reconvert the capital gain into using the TTBR into INR using TTBR as on the date of transfer. Clear? As on the date of transfer. This is the first proviso to section 48. The second proviso to section 48 is indexation. You will get the indexation benefit. Clear? Then the third proviso to section 48 provide that first and second proviso not applicable to 112A. First and second proviso to section 48 will not be applicable to equity share or listed equity oriented fund or unit trust under 112A. Then what is the deduction of the STT? Whether STT will be available, the deduction of STT will not be available here. So section 48 proviso also provides that STT deduction not available. You can here write it down. STT deduction available under PGBP. Remember in the 36 you have the deduction of STT available. Clear? Any doubt? Any doubt? Okay. Okay. Let's take a small break of 10 minutes. If there are no further questions. Okay. Let's take a break of 10 minutes and then we get back. Yeah. Yes, students. Okay, let's start the last part of capital gain. Okay. So last part which is there is in relation to section 54 exemptions which are there, that I'll quickly cover it from your module only, because these are small exemptions which are there under 54 series. Okay. So there are two kind of exemptions. One is under 10. We have done already under 10. For example, I told you about the compulsory acquisition of the urban agricultural land, which is exempt under 1037. If you remember, rural, which is any which way is exempt, but compulsory acquisition of urban agricultural land is exempt. So that was one small exemption which we had covered under 1037. Other than that, we have the exemption. If you invest the capital gain amount in the specified assets, then in that case, the exemption will be given to you, right? So we have the first exemption under section 54, exemption from capital gain. First is under 54. Under 54, what is the exemption? The eligible assessee is the individual and HUF. The eligible assessee is individual and HUF. What is the eligible capital asset which you should have transferred? Or you can write it down. Transferred capital asset is residential house. Long-term residential house. That should have been transferred. Correct? And in that particular case, what is the eligible asset which you can purchase? Eligible capital asset which you can purchase. So you have two options, or you have your options over here, where the capital gain exceeds 2 CR. Where the capital gain exceeds 2 CR, then you can invest in one residential house property. One residential house property in India. One residential house property in India. If the capital gain is less than rupees 2 CR, does not exceed rupees 2 CR, then at the option of the assessee, you can invest at the option of the assessee, you can invest in two residential houses two residential houses. So this is at the option of the assessee. And this option will be exercised once in a lifetime. So where you have exercised the option, then this option shall not be subsequently exercised for any other assessment here. So you can write it down. Once in lifetime option. Else you can always invest in one residential house property. So if the assessee has availed the option for two residential house property, then he will not be entitled to avail the benefit of section 54 again in that year or in any other assessment year. Are we clear? So you can invest your long-term capital gain on the sale of residential house. Sorry, 1 second. In one residential house property. And what is the time limit? The time limit is purchase within 1 year before or 2 years after the date of transfer. Purchase 1 year before or 2 years after the date of transfer, or construct within 3 years from the date of the transfer. Clear? So then you will get the exemption. There is a lock-in period here. What is a lock-in? You cannot transfer the new asset before the 3 years from the date of acquisition or construction. So lock-in period is 3 years from date of acquisition or the construction. In case you transfer within the period of 3 years from the date of its acquisition or the construction, then the cost of the asset will be reduced from the capital gains exempted earlier. So how will you calculate? So let's say if I have the capital gain which is there, okay. Let's say if I have the capital gain which was exempt earlier. Okay, if there's say a long-term capital gain which is exempt earlier and I have invested into the new house. Let's say of 2 CR, I have the long-term capital gains, which I have exempted earlier because I have invested into the new house. And the new house which I have purchased is, let's say, of 3 CR. Then when I'm selling the new house, let's say for in less than 3 years for 5 CR. So my sale consideration will be 5 CR minus the cost of acquisition is 3 CR of the new house. So how I will do is, if I sell, let's say with less than 3 years, let's say my long-term capital gain is 2 CR. Investment in new house is 3 CR. Sale of new house in, let's say, 1 year is 5 CR. So how I will do is sale consideration 5 CR, cost of acquisition 3 CR minus 2 CR. So I will only reduce cost of acquisition 1 CR, and this will be my capital gain of 4 CR. And this will be my short-term capital gain. Clear? Are we clear? So that is under 54. If I purchase the house and I have to invest, if I sell the house, I have to invest in a new house, that is under 54. Any doubt till now? Any questions? Any doubt? Any questions? Any doubt till now? Okay. So 54 is about that is you have to do it within the 1 year before or 2 years after the purchase, or within the 3 years you have to do the construction. Clear? Next is section 54. Okay, one more thing under 54. There is a case law which is important over here, which I would like to highlight here. See, the question is that whether the assessee would be entitled to the purchase of the flat which are adjacent to each other and having a common meeting point. So let's say if my capital gain is exceeding 2 CR. Let's say if my capital gain is exceeding 2 CR, if it is less than 2 CR, I have an option to invest in 2 residential house property. But let's say if my capital gain is exceeding 2 CR and I can only invest in 1 residential house property, then the question is that if I have purchased the 2 houses, 2 flats, which are adjacent to each other, and let's say have a common meeting point. Let's say they have a common balcony, or let's say they have a common entrance, whatever. So the question before the court is that whether the assessee is entitled. So in that case, the court has answered that yes, the assessee is entitled to investment in both the flats purchased by him, since they are adjacent to each other and have a common meeting point, which makes them as a single residential unit. So let's say I have 2 flats but the entry is common. So it is a single residential unit which is there. And therefore, I will be eligible for the exemption for both the houses. If it is a one residential unit. Are we clear? So in that particular case, I can claim the exemption. So you can just write it over here. Below this, maybe you can write it down. Purchase of 2 flats having common meeting point eligible. Are we clear? Any doubt? Okay. Then next particular section which is there is under 54. Again, we are coming to 54B. Now 54B which is there is in respect of the transfer of residential house only. So, 54B which is there is in respect of the transfer of urban agricultural land. Okay. So 54B, what should be the transferred asset? Urban agricultural land. Rural agricultural land is any which way is exempt. Compulsory acquisition of urban agricultural land is exempt. Clear? The assessee should be the individual or HUL. The transferred asset should be an urban agricultural land, which must have been used by the assessee in the 2 years immediately preceding the date of transfer. And what is the eligible asset? The eligible asset is, again, the eligible asset is another agricultural land. Purchase of agricultural land. Now, this land can be urban or rural, both. This land can be urban or rural within, what is the time limit? 2 years. The time limit is 2 years. Clear? The time limit here is going to be 2 years. Now, what if the asset is transferred before the period of 2 years? What if the asset is transferred before the period of 2 years, right? Oh, sorry, the lock-in period is here 3 years, like the 54, which is 3 years. And what if the asset is transferred within the period of 3 years? Then in that case, if it is a rural agricultural land, there will be no capital gain because that is not a capital asset itself. If the new agricultural land is the urban agricultural land and it is transferred within the period of 3 years from the date of its acquisition, then the cost of the land will be reduced by the exempted capital gain earlier. So let's say if I have the capital gains exempted earlier of 3 lakhs and I have invested in a new agricultural land of 4 lakhs, then 4 lakhs, if it is transferred for, let's say, 6 lakh, so 6 lakh minus the cost of acquisition will be what? 4 lakh minus the earlier exempted capital gain of 3 lakh. So 1 lakh only will be considered. Same as what we did in 54. So therefore, if transferred before the lock-in, if it is rural, exempt. If it is urban, cost of acquisition to be reduced by capital gain, exempted earlier. By capital gain, exempted earlier. Are we clear? So that is your 54B. What should have been the capital asset? The urban agricultural land. And what should have been the transferred eligible asset? Again, the land, agricultural land only, but that could be urban or it could be the rural. Clear? Again, here there is one case law. So the question before the Punjab and Haryana High Court was that whether the exemption under 54B can be denied solely on the ground that the new agricultural land which is purchased is not owned by the assessee, but the assessee's son is also a co-owner as per the sale deed. So the assessee had purchased the land. It was not wholly owned by him. He had purchased in the joint name of him as well as his son as well. So his son was also the co-owner. So the question before the Punjab and Haryana High Court was whether the co-owned land can be eligible for exemption under 54B. So the Punjab and Haryana High Court answered that the agricultural land belonged to the assessee, the one which was sold. And the sale proceeds of that land were used for purchasing the another agricultural land. The possession was with the assessee. Only the name of his son was added in the sale deed. So because of that, the deduction under 54B cannot be denied. Deduction under 54B cannot be denied just on that particular ground. So therefore, it was allowed to the assessee. So you can write it over here. Sorry. Merely because new land is co-owned, but funds of earlier land owned by assessee were utilized to buy new land that will not disentitle assessee to claim exemption. Clear? Any questions? Any doubt? Okay. Next is under 54D. Next is under 54D. Now, under 54D, what is the exemption is? The exemption under section 54D is on account of the, you can write down here, compulsory acquisition. Compulsory acquisition of land and building of an industrial undertaking. This is for any assessee. Compulsory acquisition of industrial undertaking. So there must have been the compulsory acquisition of any land or building or any right in land or building forming part of industrial undertaking, which should have been long-term in nature. And what the assessee should purchase is, this is long-term, eligible asset to be purchased is any land or building for shifting or re-establishing the existing undertaking or setting up a new industrial undertaking. So the assessee must purchase any other land or building or any right in land or building or construct any building. Then in that particular case, the assessee will be eligible for the exemption under 54D. Are we clear? So what is here the asset which should be transferred? The asset which should be transferred over here is the land or building should be compulsorily acquired. the land or building should have been compulsorily acquired in the industrial undertaking. In the industrial undertaking. And what should have been transferred is what should have been the eligible asset in this particular case? The eligible asset in this particular case is that the land or building or any right in the land or building should have been purchased by the assessee. Then in that particular case, the assessee will be eligible for exemption. So land or building, again forming part of industrial undertaking. So any other land or building forming part of the industrial undertaking or used for the industrial purposes. Okay. Then what is the time limit here? The time limit over here is again 3 years. So within the period of 3 years, the time limit is 3 years. So the assessee should have purchased within the 3 years from the date of transfer. Clear? And lock-in is again here 3 years. Lock-in is again here 3 years. Clear? Lock-in is again over here 3 years. And if it is transferred before the 3 years from the date of purchase or construction, then the cost of the asset will be reduced by capital gain exempted earlier. Here, one more thing. Here you can write it down. Compulsory acquisition of industrial undertaking. Here, it should have been used for the period of 2 years. Used for period of 2 years, meaning here long-term plus short-term both are applicable. So it should not be owned for a period of 2 years, but used for a period of 2 years. So even if he is not the owner for the said period of 2 years, then also the exemption in respect of capital gain from the transfer of capital asset would be available even in respect of short-term capital asset, if the assessee is using it for the industrial undertaking, even if he is not the owner for the period of 2 years. Clear? Next is 54 EC. Now 54 EC is available again to any assessee. What should have been the transferred asset? The transferred asset should have been long-term capital asset, which is land and building. Land or building or both. Clear? Now here one question which arises is whether the depreciable asset can be considered. Because if you remember under section 50, the depreciable asset is considered as short-term in nature. Right? Under section 50, depreciable asset is considered, the gains from the depreciable asset are considered as short-term capital gain. Correct? So in that particular case, whether the transfer of the depreciable asset can be considered for the purpose of 54 EC, the answer is yes. So even depreciable asset can be considered. Why? Because the words used here are long-term capital asset and not long-term capital gain. So a depreciable asset held for more than 24 months is a long-term capital asset, though by deeming fiction under section 50, the capital gains are considered as short-term capital gains. Clear? But that is a long-term capital asset. It is through the deeming fiction under section 50, it is considered as short-term capital gain. But the asset itself is a long-term capital asset, and the words used here are under 54 EC that it should be a long-term capital asset. What are the eligible assets over here? Eligible assets. Here the eligible assets are the NHAI bonds or Rural Electrification Corporation Limited bonds, RECL bonds are eligible asset. Time limit is 6 months from the date of the transfer. 6 months from the date of the transfer. And the lock-in period is 5 years. Here the lock-in period is 5 years. Also, if you remember, I had told you while we were dealing with conversion of capital asset into the stock in trade. So in case of conversion of capital asset into stock in trade under section 45(2), the sale is taxable in the year of, the capital gain is taxable in the year of sale of the stock in trade. So in that particular case, the question arises whether 54 EC exemption will be available from the date of sale of stock in trade or the year in which the capital asset is converted into stock in trade. So CBDT has clarified via circular that 6 months has to be reckoned from the date of sale of stock in trade for the purpose of 54 EC exemption. So you can make a point where we had done the exemption under, 45(2). You can write a point over there. Here you can write a point. 54 EC available from, or you can write in this way. Six months for the purpose of (54 EC) are to be reckoned from date of sale of stock in trade. CBDT circular. Okay. Okay. Now, what is the maximum amount which can be invested in 54 EC? The maximum amount which can be invested in 54 EC is rupees 50 lakh. So maximum amount rupees 50 lakhs which can be invested here. And in case before the lock-in you sell your bonds before the expiry of 5 years, then the capital gain exempted earlier shall be taxed as exempted earlier shall be taxed as long-term capital gain. In 54, 54B, 54D, your cost of acquisition was to be reduced from with the exempted capital gain amount. Here, your capital gain exempted earlier shall be taxed as long-term capital gain. Entirely, it shall be taxed as long-term capital gain. Clear? So under 54 EC, your eligible asset is sale of land or building, and in which asset you have to invest the amount, that is in the bonds, NHAI bonds or RECL bonds. Clear? So in that you can make the investment. Now again, the question before the quote in this particular case, as I said, was in case of depreciable asset, the long-term cap, if it is held for more than 24 months, it will be considered as long-term capital asset, even though the capital gain are chargeable as short-term capital gains. Are we clear? Secondly, there is one more important issue which is there. The question before the court was, can exemption under 54 be denied in a case where the bonds were issued after the 6 months of the date of the transfer, even if the assessee made the payment within the period of 6 months. So assessee had made the payment within the period of 6 months, but the bonds were issued after the period of 6 months. So the court in that case held that where the assessee has made the payment within the 6-month period and the receipt has been received by the assessee, the exemption under 54 EC cannot be denied just because the bonds were issued after the expiry of the 6-month period. So because there the assessee is not at fault. The fault is because there has been some procedural lapse on the part of issuing the bonds. The assessee has very well made the payment within the time limit, and therefore the assessee is not at fault, and therefore the exemption will not be denied. Next one is 54F. Now 54F, again, the eligible assessee is individual or HUF. And what are the conditions here? Which asset should have been transferred? Long-term capital asset other than a residential house. Long-term capital asset other than residential house. Here, even plot of land is eligible. Plot of land is eligible because that is not a residential house. And what is the eligible asset over here? Eligible asset here is one residential house situated in India. One residential house property situated in India. What is the time limit? The time limit is same as 54, which is 1 year before or 2 years after. 1 year before or 2 years after in case of purchase or 3 years in case of construction. 3 years in case of the construction. And here there is condition is that the assessee should not have more than one residential house. The assessee should not own more than one residential house on the date of transfer other than one which he is purchasing. So he should have only one residential house at the moment. So here the condition is should not own more than one house property, residential, other than purchased one or constructed one. So he should not own more than one house property on the date of the transfer. And he should not purchase any other residential house within a period of 2 years or construct any other residential house within a period of 3 years. So, the assessee should not purchase any residential house property within 2 years or construct within 3 years. He should not purchase within a period of 2 years or construct any other residential house property within a period of 3 years from the date of transfer of the original asset. And what is the exemption amount over here? Here, the exemption will be calculated in this way. It will be long-term capital gain into the amount invested divided by net sale consideration. Divided by the net sale consideration. In all other cases, what we were doing is we had the entire capital gain amount exempted. Right? But here what you would do is your capital gain into the amount invested divided by the net sale consideration. Clear? Any doubt? What is the lock-in period here? Lock-in period is also again 3 years from the date of acquisition. Any doubt? Any questions? Any doubt till now? Any questions? Okay, so here you have to purchase your transferred asset should be any asset other than the residential house property. The condition here is that you have to purchase one house property. You should not own more than one residential house other than the new asset on the date of the origin transfer of the original asset. You should not purchase any residential house within a period of 1 year after the date of transfer of the original asset, or construct any residential house within a period of 3 years from the transfer of the original asset. So in that particular case, here it should be 1 year and not 3 year. Make it here 1 year. So you should not purchase any other residential house within a period of 1 year from the date of transfer, or construct any other residential house within a period of 3 years from the date of transfer. And the capital gain amount will be computed in this particular manner. So where the assessee is purchasing within the period of 1 year or 2 years after the date of transfer of the original asset, or constructs within the period of 3 years after such date, any residential house, the income is chargeable under the head capital gain. The amount of capital gain which was exempted earlier will now be taxable, will be deemed to be the income from the long-term capital gain in the previous year in which you violate the condition. Again, here the lock-in period is 3 years. If you transfer within the period of 3 years, then in that case, the capital gain which was not charged earlier, then in that particular case, that will be deemed to be the income under the head capital gain as the long-term capital gain. Clear? So here you can write it down. Lock-in 3 years. So violation of conditions or sale before lock-in, capital gain exempted earlier, deemed to be long-term capital gain chargeable to tax. Are we clear? Any questions so far? Yes, check up 54B is for the individual HUF. Yes. Okay. Any question? Okay. So under 54 EC and 54 F, if you violate the condition, or if there is sale within the lock-in period, the entire capital gain exempted earlier will be charged as long-term capital gain. Clear? Are we clear? Okay. Now, moving towards the few case laws again in this particular area, as I said. Now, 54F, the issue which arises is, under 54F, the one issue which arises, which is also provided under your case law section, is in respect of, can exemption under 54 be denied? Again, on the ground that the house is purchased by the assessee in the name of his wife. So the house is purchased by the assessee. The funds are contributed by the assessee, but it is purchased in the name of wife. So can the exemption in this section be denied? So the Delhi High Court in that case had held that a new house need not be purchased by the assessee in his own name. So if the assessee is utilizing the money, if the earlier capital asset was owned by assessee and he is utilizing the money for the purchase of the new house in the name of his wife also, that is all right. It should not be in the name of the assessee. So that is just one point. You can write it over here. New house need not be in the name of assessee. What is important is that the funds should have been contributed by the assessee, and not that the house should have been owned by the assessee. Similarly, there is another case in where the house property is registered in the joint name. So therefore, the question before the court was, can exemption under 54F be allowed to the co-owner who has paid whole of the purchase consideration, or will it be restricted to his share in the property? Again, similarly, the Delhi High Court has held there that the 54 does not mandate that the house should be in the name of the assessee. It just mentions that the house should be purchased by the assessee. So even if it is co-owned, therefore, in that particular case, it will not be the case that the share of the assessee's house will only be allowed as exemption. The entire exemption will be allowed to the person who has contributed for that house, and not on the basis that whose name is written in the deed. Clear? There is one more issue which is mentioned under 54 is whether the 54F will be denied in respect of investment made in the construction of the residential house on the ground that the construction was not completed within the 3 years on account of pendency of certain interior work. So there was some interior work which was pending, and therefore the construction was not fully finished within the 3 years. But the assessee has taken the possession of the building, but the interior work was pending. So in that case, the Karnataka High Court held that what is the condition which is precedent for claiming the benefit under 54F? The condition is that the capital gains should have been realized on the sale of capital asset and which should have been invested in purchase or construction of residential house. If the assessee has invested the money in construction of residential house merely because the interior work was not completed entirely, but the assessee already has taken the possession of the building, then the assessee is entitled to exemption. The exemption will not be denied to the assessee. The exemption will not be denied to the assessee. Are we clear? So just because the interior work was pending, the exemption would not be denied to the assessee. There is another issue which is in the context of 54F is where the stamp duty value under 50C was adopted. The question was, can the reinvestment made in acquiring a residential property which is in excess of the actual net sale consideration be considered for the purpose of computing the 54F? So let's say, for example, if your stamp duty value is 50 lakh, actual sale consideration is 40 lakh, right? And let's say the capital gain was 12 lakh. Now, if the amount is reinvested in the residential house, then for the purpose of taking that net sale consideration, what is the formula? Your formula is capital gain into the cost of the new asset divided by the net sale consideration. So for the net sale consideration, are we supposed to take the actual consideration or the stamp duty value? So the court in that case answered that when the capital gain is assessed on notional basis as per section 50C and higher value is adopted under 50C as the full value of consideration, then in that particular case, you can consider the 50C valuation as your sale consideration. Then you have to consider 50C valuation as the sale consideration. Are we clear? So you may not restrict it only to the actual sale consideration. You can even consider the notional amount. So here you can write it down. Even 50C value can be considered here if that is higher or if that is adopted. Are we clear? Any doubt? Okay. Any questions? Okay. Next particular exemption is 54G. You can write it down. 54G, which is exemption of capital gain for shifting of industrial undertaking from urban areas. D was for the purpose of 54D was for the purpose of the compulsory acquisition of industrial undertaking. This is shifting of the industrial undertaking. Here it is any assessee. Here it is any assessee. Now here there should be a shifting of industrial undertaking from urban area to any other area other than the urban area. So you can write it down, urban area to rural area. And there should have been transfer of machinery, plant, building, land. Now, the capital gain here should be utilized for, so eligible asset is purchase of new plant and machinery, the land or building, right? So in that particular case, you can claim the exemption. Now, what is the time limit? 1 year before or 3 years after. 1 year before or 3 years after. And here also the lock-in is 3 years. Lock-in is 3 years. Now, if you transfer within the period of 3 years, then the capital gain will be deducted from the cost of acquisition. Clear? Next is 54GA. This is in respect of transfer of capital asset in shifting of the industrial undertaking from urban area to SEZ. So, shifting of industrial undertaking from urban area to SEZ. Earlier one is to rural area. Here also, if it is a transfer, the capital asset again is the same. So eligible one is same. New plant and machinery and land and building. Again, here the period is 1 year before or 3 years after the date of the transfer. And again, the lock-in period is 3 years. So it's the same. It's the same thing. Okay. One second, sorry. There's some problem. 1 second. So if you transfer within the lock-in period of 3 years, then again, the cost of acquisition will be reduced by the capital gain amount earlier. Okay. Next is 54 GB. Next is 54 GB. Now 54 GB is very, very important. This is in respect of the land or building which has been transferred. This is in respect of the residential house property, land or building which has been transferred, and this is for the individual or the HUF. Okay. Give me a minute. Here you can write it down. Time limit 1 year before or 3 years after, and lock-in is 3 years. Okay, next is 54 GB. This is by individual or HUF. What is the transferred asset? Residential property. Residential house property. And what is the eligible asset? The eligible asset in this particular case is equity shares of the eligible startup. Equity shares of the eligible startup. Right? Which company should utilize for the purchase of new plant and machinery? Or let me write this condition separately. Now, what is the eligible company? The company should have been incorporated in the year in which capital gain arises or in the following year on or before the due date of filing return of income. So the company should be incorporated, the company should be invested in the equity shares of the eligible startup on or before. So you can write it down, time limit here. On or before the due date of return of income under section 139(1). Okay. Now the company should be engaged in the eligible business. Eligible business is what? Or what is the eligible startup? Here you can write it down. Eligible business or eligible startup is in this case incorporated during One 4/2016 up till 31st March 22, engaged in the business of innovation, right, or scalability improvement, right? Turnover less than 100 CR. Turnover less than equal to 100 CR and is holding the certificate of the eligible startup, right? So the amount of consideration should be used by the individual or HUF before the due date of furnishing the return of income for subscription of equity shares. The company, the startup, should utilize the amount for purchase of new plant and machinery within a period of 1 year from the date of subscription in equity shares. In equity shares. Okay. If the amount of net consideration which is subscribed in equity shares is not utilized by the company for the purchase of plant and machinery before the due date of filing of return of income, the unutilized amount at least should be deposited in the capital gain account scheme. Okay. If the amount of net consideration utilized by the company for the purchase of new plant and machinery, right, that amount should not include any machinery which was used outside India or within India. That means it should not be a second-hand machinery. So you can write it down here. Does not include second-hand machinery. Then machinery installed in office or residential premises. In office or residential premises. Office appliances, including computer and computer software. Including computer or computer software. But in case of the startup, which is a technology driven startup, then the company can utilize the amount for the purchase of computer or computer software, because for technology startup, computer itself is the machinery. Other than technology driven startups, for them this condition is not applicable. Okay, for them this condition is not applicable. Any vehicle and where the cost of machinery is allowed as deduction. Then in that particular case, the 54 GB cannot be utilized for this particular purposes. Okay, so the net sale consideration has to be subscribed for the equity shares in the eligible startup, and it should be utilized for the purchase of plant and machinery. Okay, it should be utilized for the purchase of plant and machinery. The time limit is within 1 year from the date of subscription. In case it is not utilized till the date of return of income, then it should be deposited in the capital gain account scheme. Are we clear? Are we clear? In case it is not, then there will be the deemed capital gain. So that we are going to talk about. What is the quantum of exemption here? The exemption here is exemption over here is if the cost of new plant and machinery is greater than net sale consideration, then capital gain is exempt. Then capital gain is exempt. If it is cost of plant and machinery is less than net sale consideration, then LTCG into amount invested in plant and machinery divided by net sale consideration. Okay, so this exemption would not be available in respect of transfer of residential property made after 31st March 2022. This will not be available. Okay, so you can write it over here. Up to 31st March 2020. If the amount is not utilized for the purchase of new plant and machinery within the period specified, then the amount of capital gain which is exempted shall be charged to tax under 45 as the income of the previous year in which the 1 year expires. 1 year from the date of subscription expired. Okay. So if amounts not utilized, then capital gain exempted earlier taxable. Capital gain exempted earlier taxable. Or if the new shares, if the equity shares are or the plant and machinery are sold or transferred within the lock-in period. What is the lock-in period over here? 5 years. If the shares or the plant and machinery which is acquired is sold from the date of acquisition for the technology driven startup, the lock-in period is 3 years. In case of the computer or computer software, then the capital gain exempted earlier shall be deemed to be the income in which the equity shares or plant and machinery are sold. Are we clear? So the exempted capital gains earlier would be taxable, and this would be in addition to the capital gains on the transfer of shares or on the transfer of plant and machinery. Clear? So if equity shares or plant and machinery transferred within lock-in period deemed capital gains of capital gain exempt, or you can write it capital gain exempted earlier taxable. Are we clear? Any doubt? Gaurav, why not notional value meaning? Jacob, no. Where the wife transferred 20 lakh to husband, no. That is, the wife is contributing. Then in that case, the wife will be eligible up to that 20 lakh proportion. But where the husband itself is contributing for that particular purchase of new house from the sale proceeds of the earlier asset, then in that particular case, it will be the exemption available to the husband. Clear? Any other question? Yes, 54 GA is for any assessee. Okay. Now, few case laws, I would just cover it very quickly, what we have not covered from your module, which are important, right? We have covered the entire chapter, but few case laws, I'll just cover it up very quickly before we close the session. So there is one Supreme Court recent ruling in the case of Shisei Steels. Now, what was that ruling about? So there, in that particular ruling, the question before the court was, or before the Supreme Court was, that under the sale agreement entered by the assessee, for transfer of land. So assessee had entered into an agreement to sell the land to a person, right? Now, pursuant to this agreement to sale, the assessee had also executed a power of attorney, by which assessee appointed the director of the company to execute and join in execution for all the necessary sale agreements. So what is power of attorney? Power of attorney is just, to give the power to a person to do on behalf of oneself any other act which are necessary, right? So the assessee had given the power of attorney to the director to clear all the documents, to make all the documents, to enable the sale to happen. Now, the question before the court was that where under a sale agreement entered by the assessee for transfer of land, only permission or license had been granted to start advertising, selling, and construction on land, would it result in transfer of immovable property for the purpose of capital gain? So as I said, the assessee entered into a sale agreement for transfer of land. Under the sale agreement, the assessee granted the permission or license to start advertising, selling, and construction on the land. Assessee executed for that purpose a power of attorney under which the director of the buyer company was appointed to execute the sale agreements in favor of third party after construction on the land. Now, both the parties were required to do the specific performance of this agreement. So, in that particular case, the assessee had claimed the capital gain tax, assessee had claimed the capital gain chargeable to tax based on the sale agreement when it was signed. But the court had held that the capital gain, the High Court had held that based on the revenues argument, that the capital gain shall be taxable in the year in which a memo was signed between the assessee and the buyer company, where the power of attorney, sale agreement were just confirmed. Total amount payable, what is already paid was confirmed. The sale agreement was not signed. So a deed was signed, a memo was signed. Based on that, they concluded that the capital gain should have been taxable in that particular year. So the question was that whether under the sale agreement entered into by the assessee for transfer of land, only permission or license had been granted to start advertising, selling, and construction. Would it result in transfer of immovable property for the purpose of capital gain? So in that case, if you remember under the definition of transfer, there we have the specific provision which provides that if there is entitlement to the enjoyment of property, right? So the court in that case referred to the provisions of the Transfer of Property Act. And it concluded that in order that the provisions of Transfer of Property Act be attracted, the first and foremost condition is that the transferee must, in part performance of the contract, have taken the possession of the property. And the transferee must have performed or be willing to perform his part of agreement. So these two conditions should be satisfied for the purpose of attracting that particular clause, which is the clause for the applicability of Transfer of Property Act. So there, it is here in this case, a permission is given to start construction on the land. A license was given for the purpose of developing the land into flats and selling the same. Such license cannot be said to be possession within the meaning of the Transfer of Property Act. So if you see under that particular 247.6, 247.6 appears to bring within its tax, within its chargeability, any transfer of immovable property, enabling the enjoyment, right? So any transaction which has the effect of transferring or enabling the enjoyment of any immovable property would come within the purview of 247.6 that we have seen. But here the possession was not given, only the license was given to start selling, to start advertising, developing, and construction on the land. Here the possession was not at all transferred. So the license was given for the purpose of developing the land into flat. So here the court held that the object of 247.6 appears to bring within the tax the transfer of immovable property. The expression enabling the enjoyment of takes the color from the expression transferring. If you remember, we have done the principles of interpretation. And what is this principle? That the neighboring words take the color from the adjoining words, right? So here, if you see, the expression enabling the enjoyment is taking the color from the word transferring. And therefore, it must be read in that particular way. So it is clear that any transaction which enables the enjoyment of a movable property must be enjoyment by the owner thereof. So it is very clear that the court held that the enjoyment must take the color from the expression transferring, and there should be a transfer of immovable property. The owner's right should stand extinguished. So on the date of agreement, the owner's right were completely intact. He had the ownership, he had the possession. So therefore, in this case, there was no capital gain in that particular year. So only permission or license to start advertising, selling and construction would not result in transfer of immovable property. And it was held that the transfer of immovable property will take place in the year when the entire possession is also handed over, and not in the year when just a memo was signed or the license was given. Clear? Clear? Next particular case is in respect of, one second. Yes. Is in respect of Calcutta High Court decision in Aditya Kumar. And what was that decision? This decision is in regard to whether the amount incurred by the assessee towards clearing the title of the property acquired through will be included in the cost of acquisition. So this is similar to RM Arunachalam case. If you remember, I told you that if you are repaying the amount of loan to acquire the mortgagee's interest, then that repayment of loan will also be added to the cost of acquisition. So this is a similar decision which is there. Okay, next one is with regard to 54G, whether the advance given for the purchase of land, building, plant and machinery will amount to utilization of capital gain for the purpose of purchase and acquisition of new machinery under 54G. So whether advance can also be utilized. So again, the Supreme Court in the case of Fiber Board had held that all that is required is to utilize the amount of capital gain for the purpose of purchase and construction or acquisition of new machinery. Since the entire amount is given by way of advance, that is all right. That is not a problem. So this is in the context of 54G. What is 54G? Where there is shifting of industrial undertaking from urban area to rural area. Clear? Then the next decision is in context of would the depreciable asset forming part of the block of assets on which depreciation is being allowed. Okay, so the depreciable asset which are there, which are forming part of the block of asset, whether its character will change if they are not used for the purpose of business. So whether in that case the gains can be not considered as short-term, or still if it is forming part of the block of asset, it has to be considered short-term capital gain. So again, Supreme Court very recently in Sakti Metal Depot had answered that once the depreciable asset forms part of the block of asset, it would not cease to be the part of the block of asset even if it is not used for the purpose of business. So once it goes to the block, it becomes the part of the block. It loses its individual identity. And therefore, even if it is not used for the purposes of the business, it would continue to be the depreciable asset, and the gains on that will be considered as the short-term capital gains and not long-term capital gains. Are we clear? Are we clear? Any doubt? Any questions? Any doubt? What if the money acquired through the issue of shares were refunded back due to not meeting the minimum subscription? Will exemption claim be taxable? So if the amount is refunded back, yes, it will. It has not been deposited. That means the exemption will not be allowed. Yes. Any other question? Yes, income from other sources we are going to cover in next class then. Are you clear? Any doubts in this chapter? I would request you to solve the questions of this chapter which are given in your module. And if you have any questions, you can always ask me. See, the difficult topics I have already covered the question which was in terms of 45.4, if you remember. Yes, 54 GB is not relevant from AY 23-24 because as I told you here also, if you see, the house should have been 1 second. Here, if you see the eligible asset residential house property, if it is purchased up to 31st March 22, only then it was relevant. It is not relevant later on. Any other question? Okay. So if there are no further questions, we can just close the session today. But as I said, keep revising and do solve the questions from the capital gain part. Especially as I said, 45.4 is very, very important because that you may tend to forget. So just keep revising that. And since it's very difficult, at least I expect you to revise very often. Okay. So we can just close the session for today and see you in the next class. Thank you so much.